Hey, welcome to this video. I am so excited to have you here. I am Vijay Kailash. I run a hedge fund specializing in income producing strategies for accredited investors. And on today's video, we're going to be talking about a strategy which I personally love using during bear markets. This strategy is a lot safer than what people usually do. If you guys have any questions during any of this, leave a question in the comments below and I'd be more than happy to answer. All right, let's jump into it. So we're going to be talking about put options, right? We discussed this in the first video. If you haven't seen it, make sure you check out the introduction options video I posted below. So let's talk about put options. So if you remember from the first video, the put option gives the buyer of the put option the right, but not the obligation, to sell 100 shares at a certain price on or before an expiration date. All right, so this is from the buyer's perspective. All right, now if there is a buyer of a put option, that means there has to be a seller. Someone has to have sold the put option. So now let's look at the seller's perspective. They're obligated to buy 100 shares at a certain price at the expiration date. And so the difference between the buyer and the seller here is that the buyer of the put option has a right, but not the obligation. And you'll understand why the obligation, that piece is so important in a little bit, but the buyer does not have the obligation. The seller, on the other hand, is obligated if the buyer of the put option chooses to exercise their option. So let's look at an example. So let's say a stock right now is trading at $100. All right, the buyer of the put option can buy, for example, using this completely hypothetically, could buy a put option with a strike price at $95. Now, if you remember from the first video, the strike price is the price that you can actually exercise the option. And what does this put option do? It gives the buyer of the put option the right, but not the obligation, to sell 100 shares at a certain price. So let's walk through an example. So current price, it's at 100. All right, the strike price is at 95. Let's say in 30 days, whenever this contract expires, the stock is trading at $90. So the person who bought the put option, they're happy because they own the stock at 95. They essentially bought insurance on their stock at 95. And so even though the stock went down in price, because they bought the put option, they had the right to sell the stock at $95 because they paid a premium to get that right to sell their stock. The reason why the not obligation part is so important in the definition is because let's say the stock's actually trading above $95 at expiration. Well, in that case, the person who owns the put option, they could just sell the stock in the open market for, let's say, $98. There's no reason for them to sell it at a lower $95. So because of that, they're not obligated to actually go through and sell their stock at $95. So they have the option to sell it at 95, but they're not obligated to. And so that's very important because this is, again, from the buyer's perspective. Now let's look at the seller's perspective of the put option. So again, for them, it's the same thing. Stock's at $100. Strike price, remember, they are on the exact opposite sides of the trades. So this person bought the put option with 95 strike. This person sold the put option with 95 strike. And we're going to say at expiration, the stock can be trading at $90 just to keep it the exact same. So they're just literally on the opposite sides of each other's trades. So just very important to understand that. So when they entered into the contract, the stock was trading at $100. The seller, they actually really like the stock, right? And they want to own it, but they think $100 is too expensive right now. So what they could do is, instead of putting a limit order to buy at 95, they could sell something called a put option. Now, because they sold the put option, they get to collect a premium, and they get to collect this premium from the person who bought the put option. So the buyer pays the premium, the seller receives the premium. So if the stock goes below $100, let's say it goes down in 90, they become obligated to buy the stock at $95. But remember, the seller wanted to own the stock anyways, right? And so they thought $100 was too expensive, but they were happy buying it at a 5% discount. And they got paid a premium to wait to buy low. So they could do that because they wanted to own the stock anyways. And because it's long-term buy and hold investment, doesn't matter because they're very bullish on the stock in the long run. So even though short-term, the stock's trading at 90, they got to buy it at 95 rather than at 100. Now let's look at another example. Let's say the stock actually was trading above $95 at expiration. Well, this means that the buyer of the put option is not going to be exercising their option to sell their stock at 95 because, again, they could just sell it in the open market. So that contract they bought actually expired worthless because there's no real value to it because the expiration date has already passed. Right, we say 30-day expiration just for hypothetical numbers. Now in 30 days, if that stock's above $95, the contract expires and the seller gets to keep that entire premium and the buyer just lost the premium. And so no matter what happens from the seller's perspective, as long as, this is very important, as long as they're bullish on the stock in the long run, selling put options on a stock that you're bullish on is, I think, a very good strategy, because they could buy the stock right now at $100 and then they risk a $10 down movement in this hypothetical situation. However, if they sold a put option, they would be buying it at $95 and let's say they made a $2 premium to sell this put option. That means their cost basis is actually only $93. So let's say the stock actually did go down in 90. They're only down $3, right? Compared to the alternative of just buying the stock outright right now at $100, they would be down $10. So just by definition, people who sell put options, if they're bullish on the stock in the long run, will outperform during bear markets, right? So again, the stock's going down $10, you could just buy it outright and just lose the $10, unrealized losses, of course, because you're holding it for long term. But if you sold a put option, you get to collect a premium waiting for the market to go down. And if the market actually does go down, you only lose a little bit in unrealized losses. So this lowers your cost basis. So that way the stock only needs to recover from 90 to 93 just to break even, rather than recovering from 90 to 100. So in the long run, these price improvements can definitely have a large impact on your overall returns. So I'm going to stop right there and I'm going to give you guys an opportunity to just ask any questions below. And if you have any questions on this, seriously, let me know. I know this was a lot of information at you, but selling put options is probably one of the best ways to create passive income while you're bullish on a security, right? So let's talk about some, I guess, risks with this strategy. If you sell a put option on a specific stock, it goes down below the strike price and now you have to buy it at that price. It may take a few days, a few weeks, a few months, a few years to recover, or based on the security you sold it on, it may never recover. So because of that, it is very, very, very important to only sell put options on securities that you wish to own for the long run, right? And something that you're willing to literally hold the bag, right? You have to make sure the company is extremely strong, the fundamentals make a lot of sense, and it's very important to do that. Also, another major thing is that because each contract is for 100 shares, you need to be able to have enough cash to buy 100 shares as collateral. So $100 stock, you need $10,000 in cash to sell one put contract. And again, these are just hypothetical numbers. And so the actual premiums you do receive are going to be completely different based on different types of securities, different volatilities, different expiration periods, based on how close it is to actual strike price and just a bunch of other factors. So there's a lot to unpack here. Again, this is just high level theory. In future videos, I'm going to be posting about how to actually execute these trades. So make sure subscribe so you can learn more. If you guys have any questions, again, reach out and I'd be more than happy to answer. Thanks so much for watching and hope you guys have a great day.